My name's Dave DeBow, founder of MoneyPartnerFormula.com, and this show is built for everyday real estate investors who are actively doing deals and looking to scale using other people's money. So if you're an active real estate investor and you want to get featured on this show to talk about your own real estate and capital raising experiences, then just go to daveinterviewsyou.com. Now let's get rolling with this episode, and remember to subscribe for daily interview content. Hey gang, welcome back. And if you are in the real estate space, especially in commercial properties, you know that the cost of insurance for a lot of people has just skyrocketed over the last few years. And that is very, very annoying. It just really increases our expenses, decreases the bottom line, and affects the profitability and the value of our property. So we've got an expert here today all about insurance. Mark Tichar is in the insurance business. He works pretty much exclusively with commercial real estate investors, and he's got a ton of experience around this and helping people out with these challenging situations. So, Mark, welcome to the show. Great to have you.
Thank you, Dave. Happy to be here.
So, Mark, maybe just give us a big picture overview of what you do in the insurance space. What do the 80-20 rule? What is most of your time spent on? Who are who's kind of like your ideal client avatar? Just give us an idea of who you serve and how you serve them.
Yeah, sure. So my clientele looks something like the following. It would be commercial residential real estate.
So apartment buildings?
Apartment buildings.
Yeah.
Any client or owner that owns and operates a residential multifamily commercial assets, anywhere from 200 units to 20,000 units would be a clientele that's a pretty broad range there, obviously. We also work with clients that are investors and operators in retail and industrial and other asset classes such as, hospitality as well.
Interesting.
So the majority of the time is doing exactly what you just mentioned, helping them manage the insurance that has been a challenge of late and making sure that they have year over year the best terms and conditions at the best price.
So, Mark, you're based in Cleveland, Ohio. Do you focus on clientele that are primarily in Ohio, or are they all over the place?
All over the country. So we have clients that own property all over the country, from the West Coast to the East Coast, from north down south to Florida. We operate, I think, pretty much in all 48 contiguous U.S. states.
Very good. So, Mark, maybe let's take a look big picture wise. What are the insurers saying are the primary reasons why they've jacked up the prices so much, especially over the last few years?
Well, it's, the challenge with insurance and understanding why premiums continue to go up is I would garner to bet that most clients have low or few claims. Some clients have a lot of claims. And those some clients that have a lot of claims or large claims pull from the clients that don't have a lot of claims, which is the whole point of insurance, is the shifting and sharing of risk, right? It's all risk distribution. And so the claims, the premiums of the premiums of all the insurers that pay money into the insurance system go to pay the claims of the few. And so the challenge is year over year when you're getting increases is, how does a hurricane in Florida impact my property insurance in Ohio, right? How does the convective storm or the tornado in the Midwest impact my insurance out west? And so the insurance marketplace is becoming more and more dynamic, and there's many factors that that are attributed to that.
What are the major factors that are attributed to that? That's what I'm trying to find out.
Yeah, so the major factors are your construction type, your occupancy, and the protections that you have at your property level. So construction type, preferred classes of preferred risk profile is masonry non-combustible, concrete, things that don't burn quickly. So anything non-frame. Occupancy, Residential is always going to be a more challenged asset class. Student housing is always going to be a more challenged asset class. People live in their units. They're in their units 24/7. The stories of
things burn and flood a lot easier in those circumstances.
Yeah, falling asleep with a cigarette in your mouth, or flicking a cigarette, or the grease fire, or the oven that's on overnight that nobody, they forget to turn off. Those are the things that cause issues, right? And conversely, retail occupancies that aren't occupied 24/7, that have sprinkler systems and have concrete construction qualities, even industrial warehouses that are sprinklered with a lot of protections, are just built differently and geared towards different uses. So naturally, the residential, the multifamily market is just going to be a lot more challenged on a year-over-year basis.
Yeah, for sure. Yeah. So would you say that the insurers are saying that this quote unquote, air quote, fake news about climate change is actually causing a problem and has generated more climate related claims than, let's say, 10 years ago? Like it seems like there's been a seismic increase in insurance costs over the last relatively very short period of time. What I'm trying to find out is why.
Well, there's a number of factors. Weather is probably the leading cause of an insurance environment. So here's a great example. In 22, 23, Florida obviously is the epicenter for hurricane activity. I think in one of those years we ran out of the English letters on the alphabet, and we had to resort to the Greek alphabet to continue naming hurricane activity.
Wow.
And this past year, we're still in it, knock on wood, you don't see anything, but the hurricane activity has been benign at best, right? So, and conversely, with the improved hurricane activity, we're seeing decreases in insurance in these catastrophic markets, anywhere from 10 to 30% or 40% decreases.
That was a question I was going to ask. If the risk goes down, do the prices go down too?
Contrary to popular belief, the insurance carriers don't continue to keep the money. They have to reprice, their risk profile and based upon capacity. The other factor is that investors are coming into the insurance market because the improved financial stability of it. When you have, record high claim activity, especially hurricane activity, as an investor, would you want to dump money into an industry that pays a lot of claims? You probably wouldn't.
Yeah.
You'd want to dump money into an industry that is well capitalized and is able to weather those storms over a period of time. And that's the business that you would put money into, regardless if it's insurance or not. So a lot of reasons. But the weather patterns, I think it's also population growth. There could be houses and assets built in an area that might have had a tornado that would never have hit the news because there's no buildings there. It just went through a field of trees. Now you have a warehouse, a 1 million square foot warehouse, and you have a residential community and a retail shopping center. And that same tornado path is now going to destruct, property, which is going to cause
20 years ago it was going through an empty field. Now it's a populated area.
Yeah. So so there's a lot of things. I mean, is the weather changing? You can argue yes, but I'm not here to.
No.
Yeah.
Hey there, if you're a capital raiser, a syndicator, or a fund manager, and you're looking for a steady flow of incoming accredited investor leads, then go ahead, grab a free copy of my new book, How to Get 20 Accredited Investor Meetings Every Month Without Cold Calling, Networking, or Chasing People. You can get that at 20accreditedinvestorsbook.com. Again, that's the number 20accreditedinvestorsbook.com. Okay, very good. So, John Mark, when you get one of these calls from one of your panic-stricken multifamily clients saying, "Oh my God, my insurance rates are going through the roof. I'm going to go broke just trying to pay for these things." How can you help them?
Well, the first step is to help them not panic and to provide them guidance well in advance of a renewal. So we all know that renewals happen once a year. There's a 12-month policies. And, we can guarantee that every year they're going to renew their coverage on whatever day that they incepted it initially. And so the way that you would help a client is it's an industry and a service business built around blocking and tackling. And you get out early, you explain to the client what the market conditions are. You have benchmarking reports that show where the rates and premiums are going based upon asset class and geography. Where is the industry heading? What claims is the industry seeing? What claims are you seeing? And you get out and you basically sit down with your client and you build out a plan 120 days in advance to help them prepare for renewal. And in that conversation, you're able to glean the value of having an expert in the space who's constantly transacting insurance for real estate. Is you pull from other experiences and other renewals, and you're able to use, a plethora of experiences across your client base and educate each of your clients on what you're seeing. So the fact that our team is transacting renewals for real estate clients 12 months out of the year, we see a lot of renewals, and we can feel very confident in going out to a client 100 days in advance and giving them a high level overview of what the market is, what they can expect, and what the plan is to get them the best outcome.
And what kind of a variation do you see in very similar policies from one insurer to another? Like how much of a difference range can there be?
So that's a good question. Speaking to residential, because the residential space is the more challenged asset class, there is a finite number of markets. I could list out 25 or 30 or 40 insurance companies that we would go to. 15 of them would say no or so, right? So there's a finite number of markets that are going to naturally write residential multifamily risk. Mm-hmm. Within that, it comes down to quality of the asset, quality of your controls, i.e. operations, things that you're doing that as you operate your asset with a mind towards your risk management. When slip and trips and falls happen, managing your tenants' insurance policies. Well, statistically speaking, 80% of the claim activity that comes from the residential, commercial, multifamily space comes from the humans that are living in the buildings. So if you know that they should have an insurance policy that indemnifies the owner and provides protection. So that way, if something were to happen, the owner has some level of insulation around them to rely on somebody else's insurance policy to perhaps protect them versus tapping into their insurance policy. Because you have to remember, loss history lives on your record for 5 years. So a plan that happens today is going to be part of your underwriting process for the next 5 years. So it's simple things from, snow plowing and having subcontract agreements that transfer risk for other third parties that come on your site that might cause damage. Yeah. To making sure that, your sprinkler systems are being tested if they're sprinklered, or to make sure your smoke detection and monitoring is up to code there. So it's very basic, simple things that in the world of property management, property management is so intense, time intensive, and it's so labor intensive. And you have to try to find a way to add in risk management strategies to help you. And because it's busy enough, but it really does pay off in the long run.
So, John Mark, I guess one of my questions would be, if you've got a client and it's 3 or 4 months out before they're going to be getting renewed, comparing apples to apples, you're looking at two different insurers, very similar policies. How much of a difference can there be in the pricing? What have you seen that can be like the range? Are they all pretty much matched very, very closely, or can there be pretty big swings in price differences?
There can be swings in price differences. It all comes down to carrier appetite. So if your portfolio, the makeup of your portfolio will fit the carrier appetite, your chances are you're going to have a beneficial renewal. It might not feel beneficial to you, even if you have an increase, but in the grand scheme of the entire marketplace and where we see benchmarks, Clients with a certain profile of property are going to have the best insurance premiums on a premium per unit. And so what are some of those things? Well, right now, some markets really like to insure risk if you have a multi-building location, but each building is under $5 million in value. Okay, so there's a carrier out there that will write at a very, very aggressive rate, non-cat, mostly Midwest-based, Ohio, Michigan, Pennsylvania-based, will write, as of today, competitive rates for that portfolio. If your property in your portfolio happens to be a smidge over $5 million per value, not a fit. You have to go somewhere else. And that change can bump your premiums up, 10, 15%. From that perspective, if that carrier that is now competing on properties that's over 5 million likes your portfolio, you still have very competitive, very aggressive rates. If there's something in your particular portfolio that is not a fit for them, your rates can then go up 30 or 40% into what we call a Lloyd's of London type marketplace. So the range could be drastic depending on the specific, makeup of your portfolio. So we are seeing big swings, and we are trying to, help clients get into the best program and try to manage their exposures to fit carrier appetite, obviously being transparent and being honest about the dynamics, but trying to help clients position their portfolio to be best in class.
Yeah. Well, that makes a lot of sense, John. So from a business standpoint, what do you find works best for you these days for connecting with new clients for you and your insurance products? Or are you looking for new clients? Or are you pretty much at capacity nowadays?
We're always looking for new clients. It's going to be the simple things like going to your local, apartment association, or going to your local ICSC commercial, retail or NAIOP, or some of those organizations that support the industry, and also networking with their clients and asking them, if they know somebody that would value the help that we currently give. So it's really staying close to clients and also being active in those organizations that support the industry. And, in doing so, the goal would be to find 2 or 3 people at an association or an event that you have not met yet, and target trying to meet those few people instead of trying to, network with 50 people at a time. You're really trying to be selective and do your research in advance. So those would be the simple and the ways that, that we see, making those connections. And obviously LinkedIn and trying to be active on social media, but those would be my initial.
The face-to-face always works better, doesn't it?
Yeah,
for sure. John Mark, well, this has been very, very interesting, considering that it's kind of a, no offense, boring topic.
None taken.
So thanks for kind of, taking us for a peek behind the curtain there. If people would like to connect with you, where would you recommend they go?
You can connect with me on LinkedIn. That will be the best place to any DMs or any invitations to connect, and we can take it from there.
And I think you're probably the only John Mark Tichar in Cleveland, Ohio, so you should be easy to find.
I would say that's probably true. Yeah.
John Mark, thanks so much for being on the show.
All right, Dave. Thank you. Thanks for having me. Appreciate it.
All right, everybody. Take care. See you on the next episode. Hey there, I really hope you enjoyed that episode. And as always, if you want to listen to more daily interview content, make sure you subscribe. And if you're an active real estate investor and you're doing deals and you'd like to get featured on this show, then just head over to daveinterviewsyou.com.